Good morning and welcome back to the latest edition of InvestTalk Market Analysis for the week ending November 24th. Yeah, November 24th, holiday shortened week. And today I'm going to title the video, A Weak Dollar Helps Bulls Bring in the Holiday Season. I hope everyone had a wonderful Thanksgiving. I'm host Justin Klein, and I'm going to run down a little bit of economic data, not a whole lot this week because of the holiday, but it's always interesting to dig in a little bit there, and then we'll dig into the charts. All right, existing home sales, new lows here, 3.79 million units. We haven't seen this low level since 2010, over a decade, nearly 15 years. Can you believe that? So certainly the housing market on the existing home side is weak, and mainly that's because of low inventory. And high mortgage rates, obviously, affordability. That'll probably stay around these levels, but it's not going to crash the prices because we're not having an overwhelming amount of inventory. In fact, it still remains very, very low, although it is rising slightly. And many people use percentage increase in inventory, blah blah blah, but it's coming from very, very, very low levels. So just wanted to highlight that. Obviously, that's going to impact that industry and people, mortgage brokers and real estate agents and things like that. But it doesn't have a ton of impact on the broader economy because most in the housing market, most of the jobs that are created in the housing market have to do with building new homes, and that's still relatively robust because that's the marginal supply. We've talked about this many times before. Now, U.S. index of consumer sentiment that did tick down again, even though consumers are still spending pretty nicely, but certainly not at levels that you want to see, but not recessionary levels either. So it's just kind of hanging in there. But obviously, during the holiday season, the jobs market is weakening a bit. That's probably what is bringing this down in the month of November. Durable goods and new orders, that did kick down as well, down 5% month over month. So those are the three big data points. Not a whole lot. Overall, the Fed still remains on path to continue to pause in their meeting just in a couple weeks now. It's 2.5 weeks away. Then January, you have very high odds of a continued pause, slight odds of an increase. And then you got it into March. That's where you start to see a potential cut. And then May, you actually have roughly a 50% chance of a cut between now and May. Okay. And then you have, let's see what else. Then June, you come into June and you have a much higher chance of a cut. So that's kind of where things are kind of coalescing mid-year rate cut. Now let's dig into the charts as a whole. Here's the S&P 500. Strong rally, certainly overbought, and likely to test these highs over the coming month or so. We're getting into the holiday season, and typically when the market's up into the holiday season, you get year-end kind of Santa Claus rally. And we've kind of had that front-loaded here with a very sharp rally as of late. So would not be shocked to see a modest pullback maybe into mid-December and then a float into year-end. I think that could be a possibility. You look at the NYSE, obviously a broader index here. That one has rallied probably even stronger if you look at total percentage. And that's mainly driven by the small caps. Small caps were down on the year going into November, and we've had a strong rally here. Still need to kind of recapture this resistance zone. This is a resistance zone. You see this kind of consolidating, but this would be a bullish consolidation. So overall, I think that's really driven by the dollar. And I talked about the title of this video, the dollar rolling over, and I expect that to continue. This lost momentum was trying to break out right here at the end of October into early November, and then failed. And this is all on the fact that the market started to price in, hey, the Fed is done, right? Fed is no longer going to just continue to ramp up rates, and maybe we might be the first ones to cut around the world. So that's an interesting of note. What really needs to get traction though will be the yen. So the yen has had a little bit of strength here, but needs to get above this 100-day moving average. And then you could say this longer-term downtrend has increased reversed. And then you could see more strength, I think, in overall asset prices and more more weakness in the dollar. Really, this weakness has to do with the euro. And I do think the euro is going to be the source of this. Why is that? Well, think of where interest rates have gone. We in the United States have fixed rate mortgage rates. And if interest rates go up, people should stay in their homes, right? We talked about this before. Well, in Europe, there's typically floating rate debt and it resets every couple of years. And so they have felt the impact of higher rates much more than we have. And so over time, that's actually going, they've kind of front loaded that pain there. And you've had mild recessions in Germany and parts of Europe, et cetera. And I think our odds of going into recession are higher than that, and they might come out of recession slightly, right? Because it's all about base effects. Looking over the last year, they've had a lot of economic pain over last year. We have not, right? And so that easily could be flipped over the next kind of 12 to 18 months. And so I think that's a big reason why you could see foreign assets do a bit better, the dollar be much weaker. And so I'm actually starting to get more bullish on like emerging markets. Here's EFA. Let's look at EFA. EFA getting that strength here. This is the developed markets basically, and so would not be shocked to start to see the dollar continue to weaken and those foreign exposure to do much better. Let's look at the MOVE index. That's another aspect that continues to improve here. The Treasury market, we talked about that kind of perking up, the MOVE index perking up, trying to create this bullish consolidation to maybe break 150 and create some problems within the Treasury market. And basically the Fed pause is taking that off the table. So for now, the Treasury market issues, I think, are not really there. In addition, the Treasury has kind of shifted their issuance to more on the short end versus the long end of the curve. And so I think for now, we don't have a ton of near-term debt issues that are going to disrupt the market as a whole. The VIX, that remains very, very low. So that's obviously positive 12 is near record lows here. So clearly there's not a lot of worry in the market and even the credit market. So if we go over to the SHYG versus the SHY, so short-term junk to short-term treasuries, that remains in an uptrend, at least especially recently, and not breaking down. I talked about, do we break below the banking crisis lows earlier in the year? And we did not. We made a higher low, and so no credit event, at least in the near term. Let's see, sectors. Energy has pulled back recently, but it's got a bit of strength last week. And then industrials, I think, are getting the strongest reversal here. Financials also finding some strength as well on that Fed pause announcement and the fact that the Treasury market isn't really, causing a problem. Utilities also gaining some strength, and a lot of the ones that were hurt by higher interest rates are now benefiting from that reversal in the rates market. You see the 10-year peaking out right around 5, and now we're closed the week right around 4.5, 4.47. And I expect the Treasury market to be more choppy, so don't expect this to, Treasuries to rates to go back to 2% or something like that. Pulling back into high threes certainly possible, but you'd have to see much weaker economic data, which certainly is possible going into the new year. What else do I want to get to? Oh, let's look at growth to value. So another aspect that's underrated about that's not what I want. SPYG to SPY. So this is S&P growth to S&P value. So one thing that's underrated about the growth to value trade is not just interest rates. Obviously, when interest rates go up, that tends to be bad for growth stocks, but also the dollar. So strong dollar means weaker economic growth. Weak economic growth means investors are going out there and looking for growth elsewhere, right? In more secular trends, like you see on the growth side of the market, and so money tends to flow there. But when you see the dollar weaken, that portends to actually better economic growth domestically in the near future, because our products become more competitive, and that moves money more, and obviously commodity prices tend to rise as well, and so that's on the value side of the market. So money just tends to flow towards the value side, and that's what you've seen as of late. The dollar tends to peak. This ratio is peaking, and you're starting to see that shift back towards the value side of the market on the weaker dollar. And obviously, our fiscal situation portends probably longer term to a structurally weaker dollar as well. So be cognizant of that. Gold, that one remains strong. Obviously, that reversal in the dollar, reversal in rates, that's also all good for gold prices. Kind of consolidating here right around the 2000 mark on gold prices, and it doesn't kind of reflect on the GLD because there is an expense ratio here, but that's where gold tends to is trying to find a breakout level. Silver to gold ratio, that one is starting to perk up as well and starting to break out. I talked about how this needs to gain some traction for you to see a real breakout in precious metals, and on Friday it certainly helped with that silver move. So you're starting to see some nice strength in gold and silver. Let's see, transportation index remains starting to reverse as well. So big pullback, found support, and we'll see if we can break through here in the month of December, which we're rapidly moving into. So overall, overbought near term. Dollar's weakening, which is generally good for asset prices, especially the value side of the market. But when you are overbought and you move so quick, so fast on the major indices near term, you could easily see a pullback. So don't be shocked if you see that over the coming couple of weeks. It would be something like this, pullback into this breakout area, probably low here. This would be major support. You have this gap right here. You have this breakdown area, right? So pull back into 4460 on the S&P-ish, somewhere around 100-point pullback in the S&P would not shock me at all. But overall, we're heading into holiday season, Santa Claus rally. Once again, kind of front-loaded, but you probably are likely to see general broad move higher into the new year. And then the new year, things could change, right? Especially because of the economic trends, which continue to weaken a bit and are likely to push us into a mild recession by mid-year. But that's still not guaranteed. That's just generally what the likelihood will be, and obviously that could change. And we're heading into an election year as well, so that's going to become more contentious, both on the political level as well as the economic level as well. So that's where we are at. I appreciate you all tuning in. I hope everyone has a wonderful holiday season. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.